Hi and welcome. This is Abhinav, and in this video, I'm touching upon some certain points from a US and India tax perspective and some FEMA points also. Uh, with respect to US green card holders, so person is a US green card holder and he has investments in US as well as India. So, what are the points that one needs to keep in mind from a tax perspective mainly? So, one is that if you're a US green card holder, then basically you are a US resident, right? Now, wherever you live across the world, now you are wedded to the US tax system, right? So your Indian investments that you have, the income from those investments will be taxable in US without any exemption. Everything will be taxable in US. So you invest in India, so you are a NRI as per the Indian tax law. Then you invest NRE fixed deposit, you think they are tax exempt in India. They are tax exempt in India till you are non-resident, but they will be taxable in US. You have PPF investments in India where you are getting money, the whatever interest that you get, tax free interest, it will be taxable in US, right? So, and wherever you move to Spain, you move to any other country, wherever you live, the whatever income that you earn will be taxable. There is a limited FTC, what foreign tax credit. So for example, you have like Indian mutual funds or Indian shares that you sell in India. So India will impose whatever the tax that is applicable at 12.5%. That tax will, you can get the tax credit of that whatever tax that you've paid in India. But the in the US, the foreign tax credit provisions are such that you only get a proportionate credit. So you go and get a credit. If 100 rupees credit is there, you get 100 rupees into what is the US income, sorry, Indian income with respect to the total income. You don't get that whole of the 100 rupees credit. So you need to check those tax provisions. India US DTA is a very weak DTA. It's unlike the more advanced kind of DTAs like US Canada DTA, where you get a lot of exemptions and all. But India US DTA very weak. Basically everything is taxable. Only in certain cases there are certain lower withholding rates that are available for interest, dividend, all those things. But otherwise, there is not much protection, right? Some states in US, they do not give credit, like California. They don't. So in US, there is a system that there is a federal tax structure, and then the states also have the right to tax, right? So up to like even like 9 to 13%, up to 13%, the California can tax. So on that same income, right, of their Indian income, but whereas US, another federal tax, you get the tax credit. The state, like California, will not give you tax credit of the Indian tax, right? So you need to also check the state law whether you'll get the credit, right? And and these are all these are one of the many points why I always say that if you're a US resident, US green card holder, US citizen, better to have your investments in US only rather than investing in India, doing all the compliances of the India investments, problems with respect to FTC, the PFIC regulations and all. So better to invest in US in view of all these issues. Um, if you have your investments, some part of investments in India, you don't want to liquidate them, then fine, no problem. But always make sure that you include the income in your US tax return as well, right? Okay, best to keep the funds in USD. Take India if you want India exposure. So India is also a strong economy like a US, right? And there are only two main strong economies that we have at this point in time. So definitely you can take India exposure, but take it through focused ETFs, India ETFs, which are there available in US, right? So when you invest through that, there are no kind of PFIC implications, right? There are no FTC issues, and you can also take the exposure. Only thing is that the investment will be in USD, right? But that's fine. You get the exposure, you get the advantage, your investment is diversified. If you want to invest in India, okay, you are saying that okay, I still want to invest in India. You can invest, but there are certain restrictions when you invest in India. You cannot. So first of all, you have to if you have not redesignated your bank accounts, you need to redesignate, make the resident accounts NRO, and then you can invest. You can open a separate NRE to invest repatriable funds through the NRE route. If you invest in first, if you have uh, the resident demat account, you have to close, open a non PIS account. If you want to invest in shares, you have to get a demat account under the PIS approval. First, you have to get the PIS approval and have a PIS demat account, and then you can buy the Indian share. Because see, Indian tax authority, Indian government basically wants to track any money that is coming from the non-residents, and they have limits in which the exposure that a non-resident can hold in Indian companies. So to track that, they have these rules. So don't try to bypass these rules. You will expose yourself to a FEMA contravention risk. I've made a separate video on not investing through significant amounts through your parents' name, close relatives' name in India. If you get stuck in FEMA, that's a big problem that you can face, right? Because of the FEMA rules, how they are structured, the penalties under FEMA, right? So it's basically a draconian law, right? So invest in India through proper PIS route. You can invest ensure while investing, it's not you're investing in shares and bonds, direct investments, right? No PFAK pooled type of investments, no mutual funds, no ETFs. Now, NRIs who are wanting to invest in Gift City, my request to you will be, wait. The current regulations, the investments under in the Gift City, the current regulations are there that they are considered as AIF, right? And there's a minimum, I think, of ticket size per scheme of US dollars 1.5 lakhs. So right now the regulations are being streamlined, made easy for NRIs to the retail investments. The regulations are being streamlined. So we need to wait and see how the things are. I'll make separate video on Gift City taxation. So wait for that video. But right now we'll have to wait for Gift City and see how the regulations emerge. Align investment with your financial goal. First, always when you have an investment, see what financial goal you're investing. Accordingly, you can decide what exposure you need to have towards risky assets, non-risky assets. I'll make separate video on the from the personal financial angle, how you need to position your investments. It's not just that you blindly make the investments. You have to tag it to your financial goal. You have to properly diversify. Okay, so much is between in US, so much is in India. For any INR goals, if you have any INR goals, still I will suggest, if you're a US green card holder or even a US resident living in US, keep the investments in US. There will be a small currency risk. And what will be the currency risk? It's the kind of a reverse impact where the Indian rupee becomes kind of stronger with respect to US, and less likely, but even that is there, be prepared to kind of live with that currency risk, because the IRS compliances, the FTC issues are far higher in terms of burden as compared to the currency risk. Or if you still want to keep the funds in Indian currency, then definitely you can keep the funds in NREFD, the fixed income component. And other than that, you can have open out through a PIS route. You can open a demat account, a fresh demat account, and then you can invest your funds from the NRE into the Indian shares, right? Indian shares or Indian bonds. Don't invest in Indian mutual funds. Then if you have significant corpus like 10, 15, 50 crores, and like you have businesses also that are running in US or in India, always highly suggested to explore private trust structures. Understand, my friends, the times are gone when private structures were used to kind of stash black money and all. Those strategies will now not work with the uh, exchange of information agreements that are happening between the countries. But the real purpose for having a private trust structure is, if you have properly want to consolidate your assets at one place, have a proper direction from a succession planning point of view. Or if you have businesses, you have creditors, and you want to protect your personal assets from an asset protection perspective, you can invest personal private trust structures in US or in India. uh, know that there are certain Indian FEMA compliances that are involved with. If you have Indian resident trustees, beneficiaries, Indian assets, I'll make separate video on exploring private trust structures and the FEMA angle that comes in. A lot of tax consultants also don't consider the FEMA angle, but then the entire thing you plan, and then there is a one thing that is in FEMA that can be a showstopper, right? So if you have significant investments, you can explore these structures. You can take help of family offices or consultants in India and US who can plan your affairs in a better way, right? Even from an estate tax perspective, there are also jurisdictions like UAE which are tax free jurisdictions where you can explore kind of creating such structures. I'll make more videos on those topics as well. If you plan to invest significant amounts in India, then the mutual fund is out of the way. So if you were thinking that to get a professional management, instead you can explore family office type structure or a PMS. You can think of investing which has a kind of ticket size of 50 lakhs and above, so INR and above. so that your funds can be professionally managed, and also there is no pooling, right? So you can give specific instruction that there should not be a pooling, so that the transactions do not attract PFIC uh, implications. Have an estate plan in India, separate will for US investments, separate will for Indian investment. You cannot have one will which takes care of all the investments. So you need to consult the tax attorneys who specialize in the will preparation and everything in US, and get it in US and India. If you have significant funds that you want to plan out properly for your children, especially if you have special needs children and all, highly advised to opt for the trust structure. If even if investing in US, so even if you invest in US, there is always the option to retire back in India at a future date, right? So Indian FEMA regulations are very kind of open, that you've earned money in US, and that money, if you want to later date bring back to India under section 6(4) of FEMA, you can definitely bring back to India, or you can keep it in US. Whatever you want to do with that money in US, Indian FEMA authorities will not question you, even if you become an Indian resident. So that all option is there. So don't think that if I have investments in US, later on if I want to retire in India, that can be a problem. Yes, there can be a small currency risk that you'll be exposed to, in a situation where the Indian rupee becomes very strong with respect to the USD, right? Then there are certain compliance and restrictions under FEMA in investing by the PIS route and setting up company. So any NRI wanting to invest in India after becoming a NRI, there are certain compliance and restrictions under FEMA that one needs to keep in mind, or setting up company in India which is treated a foreign direct investment. So those requirements are there. Then if you are a US green card holder who has interests in Indian company, so one is the FBAR and form 8938 requirements with respect to Indian investments that you need to keep in mind. Please be very careful and diligent with these reportings, because the penalties are very high. If you have missed reportings, if you have missed all those reportings, doing those reportings, you can opt for the streamlined domestic procedures, STOP. Those procedures are available, where you may pay a certain penalty and you regularize your affairs. So there are dedicated tax consultants who do this work. I'll also make a kind of a video on that, right? So you can take help of that, but ensure that these reportings are proper. Then if you have interests in Indian kind of companies, or partnership interests are there, you need to also, if you have like a business in India, you need to also file form 5471. Then under the India US DTA, there are very limited kind of DTA benefits for US green card holders, because they are treated as US residents, and there are specific saving clause in the India US DTA which says that those benefits that are there available will not be given to the US residents, which are defined under the in that particular article. So the benefits are very limited. So don't 100% rely on the India US DTA. Then check certain conditions. So if you are a US green card holder living in India, doing business in India, you can get deductions under the foreign earned income exclusion, foreign housing deduction. But there are certain conditions. There are lot of conditions that are attached with respect to those deductions. So you need to first check those deductions. You need to have a tax home in India, then only you can claim. So those deductions also you need to sit with your CPA and check before you plan your activities in India, right? So this is it. I hope there are certain pointers that you can then think about. If you have any thoughts, comments, feedback, do share in the comment section. Thank you so much for watching this video.